Hello, everyone. A very good morning to all of you here. Thank you for coming for today's session. And I hope all of you here have started the year on a very good note. So today's session will be a very short one, and I will be sharing on the market outlook for 2022 and how we are positioning ourselves in the stock markets for the year ahead. But please take note that this is definitely not a forecast or a prediction of what's going to come in next in the markets. Well, we have always been emphasizing that as an investor, our role is never to predict the stock markets, never to predict what's going to come in next, because no one have that ability to be able to 100% and accurately predict what's going to come in next. So what we can do, what investors can try to do is to understand what is happening in the markets, try to make sense of the events, and just go with the trend and just follow where the markets are going. That's the best that we can do. Okay, the best we can do is to extrapolate based on historical trends or historical statistics. But then, even then, there is no 100% guarantee that things are going to play out the same way as what has happened in history. Okay, so before I begin, the usual disclaimer here. Please take note that whatever I share with you guys today, they are my personal opinion, and please do not take it as financial advice or financial recommendation. And as usual, always do your own due diligence, and if need be, do seek professional advice. Okay. So for those who are attending our Zoom sharing session for the first time, I'm Hazel, the co-founder of the Joyful Investors. And we hope to be able to help more retail investors who are on this investing journey to make their journey a joyful one. So from time to time, we will be holding such sharing sessions to share about investing tips or to share about our take and views on what's happening in the markets lately. So if you want to be in the loop for more of such future sharings, do follow us on our social media platforms, Facebook, Instagram, and as well as our Telegram channel. Okay, so with that, let's begin. So for those who have been following us, you guys probably know that we are mainly invested in the US markets, the China markets, and the Singapore markets. So for today, let's start off with the US markets first. Okay, so what happened last year was that the US saw more aggressive fiscal stimulus that boosted the economic recovery. And for 2022, the real GDP growth for the US economy is projected to be at about 4%. And the general sentiments and consensus is that though the fastest pace of recovery has now been over, because that was back in 2021 last year, but overall, with higher naturally acquired immunity, that means more and more people getting COVID and becomes naturally immune to COVID, and with higher vaccination rates, as well as the expected rollout of the oral antiviral pills, the pandemic situation is expected to continue to get better. And of course, when I say the situation is going to get better, it also means living with the new COVID variants. Okay, because about a month or so ago, sometime in November last year, when news of the Omicron variant arose, it got many investors talking about it. So here you can see the news talking about how the Dow Jones tumbled by 900 points for the worst day, S&P 500 dropped 2%, stock market slammed by Omicron variant concerns, and so on. So maybe it was due to the Omicron variant, or maybe it was due to the Fed's change in monetary policy. The S&P 500 retraced slightly in end November and in December last year. So if you look over here at this box that I've drawn out, that was the retracement that we see last year in November and December. Right, so at that time, during the end November period and early December period, we also wrote a blog post about how this Omicron event is being overplayed. Because you see, moving forward in 2022 or even perhaps in 2023, we can still possibly expect to be hit by other new COVID variants. So the worst thing that you want to do as an investor is to panic and think that the market is going to crash or that you're going to lose a lot of money. Okay, because remember at the start of this webinar today, I said that as an investor, our role is not to predict the markets. We don't know when is the next new variant going to come. But the best that we can do is to learn from what we have gone through and try to pick up insights that may be applicable for the future. And that is the most educated analysis and guesses that we can have in the markets for ourselves. So what we learn from history is that markets hate surprises. When thrown with surprises, that is when the markets react the most aggressively and the most negatively. If you look over at this chart over here, well, this is not the most updated chart of the S&P 500. It was the screenshot that I took back then when I was writing the post on Omicron. But nonetheless, if you look over here at this chart, the message that I'm bringing across is that if you see, the biggest crash or the biggest pullback that we faced was during the COVID crash around here. Okay, it was during here, the COVID crash. But subsequently, as we have new COVID variants like Alpha, Beta, Gamma, Delta, Omicron, we only saw just dips, okay, of like 5% or less, or maybe slightly more in 2021 last year. So what this means is that what history is telling us is that the market hates surprises. Because back then in March 2020, what happened was that all of us were caught by surprise when the COVID situation was spread out of China to other parts of the world. So we were all caught by surprise at how contagious and how serious the COVID situation was. So that's why the market reacted the most aggressively. But subsequently, with all these new variants coming along, we saw that the S&P 500 did not react that negatively. We only just saw small dips and small pullbacks last year. So this is something that is important to understand, and it's something that we can draw from what has happened in history. Well, I'm definitely not a virus expert here, but as investor, we can also rely on data to help us understand things better. So you can see that over time, the variants, okay, or the virus, okay, seem to be more manageable in terms of the death counts. We are also seeing a lower and lower peak with each new outbreak. So disruption to the economy should then, the impact would then become smaller and lesser as time goes by. But in the event, if let's say the new variants really become deadlier, more contagious, and also deadlier and more serious, resulting in more lockdowns and so on, we also saw in history how a COVID crash will still eventually recover as soon as the situation becomes more contained. Okay, so that is what we learned from history. So there is, I would say there is nothing much to really panic about. So this is for coronavirus, okay? And perhaps something that's even a bigger concern or a bigger headache for investors right now is inflation, the topic of inflation and rates hike. You just read the financial news, you go to YouTube, you just surf the internet, you will see articles talking about inflation being the top fear for market participants right now. Even if you go to forums, you go to brokerage platforms, you will also see retail investors being very concerned about inflation impacting the 2022 stock markets. Well, sometime last week, I just did a very simple Google search with the keywords inflation, stock markets. And here are the top results that I see. And it seems that, you see, all the top results seems to be more on the pessimistic and the fearful side. Right, so let's understand more about this event, inflation and rate hike. Okay, and it certainly doesn't help that we started the year 2022 with a pullback for the technology stocks. Nasdaq was down by about 4.5%. This is the latest chart since the market closed yesterday night for Friday. Okay, Nasdaq was down by 4.5%. And of course, the individual tech stocks, they will hit even harder. For example, if we look at Adobe was down by about 8.2% for the year to date, as well as if you look at Netflix was down by about 12.8%. And there are also many other tech stocks getting the hit as well. Right, so I came across this interesting survey that was done by CNBC with 400 chief investment officers, equity strategies, portfolio managers, CNBC contributors who manage money. Okay, sounds like all the experts at investments. Right, more than half of them said that inflation is their biggest worry in 2022. And 30% said that the Fed raising rates at the wrong time is the top concern. So it seems like everyone is really very worried about this inflation and the rate hikes. What about you guys here? Do you feel concerned about inflation for the stock markets? If you also feel concerned, can you type a yes in the chat box and let me know? If you feel that there is nothing much to worry about, then you type a no in the chat box. Can you let me know in the chat box? Do you feel concerned about inflation and rate hikes? Hui Zhen says yes. What about the rest? King Xiong says yes. So the rest? Same. Jason says same. Yes. Robin says yes. So it seems like all of us are all very concerned about inflation as well. Okay, so let's move on. Okay, what happened was that in November last year, the Fed started tapering. And at that time, the Fed said that they don't envision that the rate hikes are going to come that soon. And even then, sometime during September last year, projections came up and say that at most, there will only be one rate hike, interest rate increase in 2022. But just 1 month after that, in December, the Fed suddenly announced the plans to accelerate tapering and said that they are likely going to start raising interest rates once the tapering ends. And this time around, the Fed officials say that they see as many as 3 projected rate hikes coming along. So for those who do not know what tapering is, tapering refers to the slowing down of the bond purchases. Okay, before we move on to talking about the impact on the stock markets, let me just explain the economics behind this. So let's take a very short economics lesson. Okay, to better understand this whole situation, we have to go back to when we had the COVID crash in 2020. So during that time in 2020, the economy was not doing well. So what the Fed done was that they bought more bonds. Okay, they buy more bonds in the open market because by doing that, they induce more liquidity and they increase the money supply in the economy. So as a result, interest rate dropped because by doing that, that pushed down the interest rates. And with lower interest rates, it means that it is cheaper to borrow money. So when it's cheaper to borrow money, okay, that will encourage more borrowing, that will encourage more spending and consumption. So all this would then, as a whole, boost the economic activity and help to boost the economy, make the economy recover faster. Okay, so this is also what happened when the economy was not doing well. Right now, okay, 2021, 2022, the economy is recovering well. People are actually spending more. And when people are spending more, businesses are also doing better. So this actually resulted in higher inflationary pressures. So what the Fed says now is that they want to tighten their monetary policy, which is why they started tapering, which is to slow down the process of the bond purchase. Okay, and right after tapering wraps up, they want to raise the interest rates because of inflation. Okay, so this is what happened. And what has stirred negative sentiments in the markets is that the Fed had initially said that inflation was transitory. Okay, why the Fed said it was transitory? It was because the Fed thinks that inflation was due to pandemic-related factors, such as pent-up demand. Okay, that means people were in lockdown mode; they cannot really buy. Okay, pent-up demand, and that has outstripped the supply. Okay, because there was some supply chain bottleneck also due to this pandemic. And by saying that it's transitory, it means to say that okay, all this will fade eventually as soon as the pandemic situation becomes better. But soon, this transitory word was soon retired. And now we are expecting a rate hike very soon. Okay, so question, why does the Fed need to raise short-term interest rates when there is inflation? Okay, so this is also part of our short economics lesson. Because you recall that when interest rates increase, it becomes more expensive to borrow money, right? Interest rate increase, you want to borrow money, you have to pay higher interest rates. So there will be lesser borrowing because of the higher interest rates. And that will also help to reduce consumption. So by doing that, lower borrowings, lower consumption, this will help to slow down the economic activity and hence help to alleviate the inflationary pressures. This is why the Fed wants to raise the interest rates to tackle inflation. Okay. So what has this got to do with the stock markets? Right, in theory, when the interest rates increase, all else being equal, the stock prices will decline. This is the conventional wisdom that we learned from finance textbooks. Why? Because future cash flows will be discounted at a higher interest rate. So that will then give you a lower valuation for the stock, for the value of the business or the value of the stock. But notice that I said this is in theory, because in practice, this may not be the case. Okay, let's see why. If you look over here at this chart over here, the first bar, okay, this first, sorry. Okay, this first bar over here, it represents the annualized S&P 500 returns over a 12-month period subsequent to a Fed rate hike decision. Okay, and you can see that this second bar over here, it is the annualized return for a 12-month period, okay, in the wake of a rate cut. So you can see that actually during times where the Fed raised interest rate, the S&P 500 actually produced a return that is even higher than during times when the Fed cut the rate. So this is actually contradicting that conventional wisdom that we learned on finance textbook. Okay, so it seems that what we learn on theory, what we learn in the finance textbook may not necessarily hold true. Another one here. Okay, we can see here, okay, all these gray shaded areas, they are the periods whereby there is rising interest rates. So there are 7 gray shaded areas over here. And out of these 7 gray shaded areas, the research has shown that the S&P 500 actually returned a overall return of 15%. So actually that's not bad, right? Okay, the S&P climbed at an average rate of 15%. That's not bad. So what it means is that it does not necessarily mean that when interest rate increase, stock markets are going to be doing badly. It doesn't mean that the US stock market will definitely be doing badly. Okay, why? The reason is because inflation can also be an indication that the economy is growing very well. It is recovering very well because consumers, they are spending more, okay, which resulted in all these inflationary pressures. Okay, but when consumers are spending more, businesses are going to be doing better. Okay, that's going to help the business to improve their earnings, to improve their cash flows. So overall, over the long term, the valuation of these businesses will then continue to increase over the long term. So this is why inflation and interest rate increase does not necessarily mean that the stock prices are going to drop. Because if businesses are doing better, if the valuation are going to be better, the stock prices would go up instead. Okay. In the short term, yes, in the short term, or when there are new announcements of the Fed's upcoming plans, we may see the markets reacting. Okay, I'm not saying that the stock markets are going to go up, rally up with no retracement or with no pullback. In the short term, yes, the stock markets may react, or rather, we have already seen the markets reacting right now. If you look at what happened to Nasdaq, S&P 500, so we may see a dip. But over the mid and longer term, prices should generally still rally up. Okay, 2022, we started the year with a 4.5% pullback for Nasdaq as the technology stocks took the hit. But in the long term, as long as earnings and fundamentals continue to support the prices, these tech stocks are still poised to rally up strongly. Okay, as long as there is still earnings growth, the fundamentals can still support the prices. Okay, so always go back to the fundamentals. In the short term, there will be a lot of events happening in the markets. There will be a lot of noises in the markets. But these don't matter. As long as the companies are still doing well, they are still generating good profits, good cash flows, that will support the fundamentals and the valuation of the company. So, which is why we are not really concerned when we see the news covering about inflation or covering about how equity investors have to be careful, right? Because news articles, they like to play with the words and they like to use very strong words that can induce a lot of fear. So I hope the statistics and the historical evidence that I've shown you can help to calm you down as well if you are also worried about inflation in 2022. Okay, in a short term, if let's say it turns out that there is an even bigger pullback, like what we have learned on theory in conventional wisdom, then grab that opportunity to add some good stocks that you would want to invest in, that you have conviction in. Grab the opportunity to buy them at cheap prices, at bargain prices. But in order to be able to do so, you need to have cash at the sidelines. If you don't have extra cash at the sidelines, you wouldn't have that money to put into the stock markets to buy. So it is very important to also have some cash at the sidelines, which you do not require for your short-term consumption needs, and that you are comfortable to put that money to work in your investments. So for this one, I've also previously addressed this topic of whether retail investors should hold cash at the sidelines in one of our YouTube videos. So you can check that out if you want to know more, because I'm not going to be covering and elaborating on that in today's Zoom session. And by the way, we are also doing a Ask Me Anything segment on our YouTube channel and on our blog post. So if you have any burning questions on investing that you would like to ask us, you can also send them into this link over here that you see on the slide. You can also send them into this link over here. You can also find the link at our social media platforms as well as our YouTube video description. Yeah. Okay, so let's move on. All right, so inflation covered. So we have covered so far coronavirus and inflation. And I would say these are the main events right now that we see many retail investors being concerned about. But what's even more important is to understand that it's not just for 2022, it's for any year, for 2023, 2024, and so on. It's to understand that such macro events like inflation, supply chain bottlenecks, rate hikes, or maybe in the future you will also experience a rate cut. All this has happened again and again in history over decades. Okay, but what is important to understand is that the S&P 500 still continues to rally up eventually. Okay, if you look over here, it still continues to rally up eventually. Okay, even though there are so many events that have happened before, recession and other negative events, but eventually the S&P 500 will still rally up over the long term. Okay, from time to time, we will experience dips, we will experience corrections and even crashes during recessions, but that is part and parcel of investing in the stock markets. And this is something that we must understand. Okay, if you look over here at the statistics, you can see that a decline of 5% or more, okay, a decline of 5% or more happens on average about 3 times per year. And a decline of 10% or more happens on average about 1 time a year. And a decline of 15% or more happens on average about once every 3 years. And lastly, when we talk about crashes, 20% or more, it happens about once every 6 years. Right, so dips, corrections, declines, they are going to be happening almost every year. You will have something. Yeah, in fact, for the last year, 2021, the S&P 500 delivered a very strong performance, which is something that you won't see happening every year. You won't see the S&P 500 giving an overall return of 25% or 27% every year, okay? Because the annualized average return for the S&P 500 is about 10 to 12%. Okay, so if you only started investing last year and you thought that this is how the US stock market is going to be like every year, then I'm sorry to burst your bubble. Right, the average annualized return for S&P 500 is about 10 to 12% historically. Not every year is going to be that a great year like 2021. Okay. And even during years, okay, in which the S&P 500 delivered an overall positive return, chances are that we will still experience a price decline within that year. Okay, if you look at this chart over here, the green color bars represent the overall return for that year itself. So if the green color bar is above the x-axis, this is the x-axis. If it's above here, it means that for that year, the overall return is positive. If the green color bars are below the x-axis, it means that for that year, the S&P 500 generated a loss, an overall loss. And all these red color squares over here, they represent the intra-year decline. That means to say that the percentage dip or the percentage of the pullback that happened during the year. So out of this 20 years data, okay, this is from 2000, the year 2000 to the year 2019. So we have 20 years of data here. And you can see within this 20 years of data, there are actually 11 years out of 20 years whereby the pullback for S&P 500 is 10% or more. That means this red color thing, the figure is 10% or more. But eventually, out of this 20 years, only 5 years delivered an overall negative return. 15 out of 20 years delivered a positive return. So you see that? So what it means is that it doesn't mean if now markets are coming down, markets are retracing, it means that the markets are going to crash for the year or the market is going to be doing badly for the year. That is not true. Okay, in fact, out of this 20 years, most of the time, the markets actually return a positive return. Okay, so the point of showing you this is to tell you that pullbacks and all that in the short term, they are actually a very natural part of this whole process of investing in the stock markets. Okay, but you don't have to panic. Okay, the worst is to panic and then you just sell them off when the markets are dropping and sell at a very, very bad price. Always remember that in the short term, the stock market is a voting machine. And in the long term, it is a weighing machine. Okay, so don't give in to panic selling. Well, earlier on I talked about this survey, right? That was conducted by the CNBC with all the 400 investment experts. Another question that they put up in this survey was to ask the respondents to give their guess on the returns of the S&P 500 for the year 2022. Okay, now we know that historically, S&P 500 on average gives about an annualized return of 10 to about 12%. Okay, but interestingly, if you look over here, actually 80% of these respondents think the S&P 500 is going to be performing below average. If you look at down by, okay, about from here to here, this is 80%. Okay, sorry, my handwriting is... So for this four over here, all this, it makes up about 80% of the respondents. It means that 80% of them thinks that the stock markets, the US S&P 500 will be producing a return that is less than historical average. Okay, how true this is going to be, I don't know, we don't know, because again, we don't have the ability to predict the future. But let's do a very quick poll here as well. Okay, this is just for a fun guess. Which option would you guys choose if today you were the ones doing the CNBC survey? Which one would you choose? What is your guess on the return for S&P 500 for this year? Can you type in the chat box? This is really just for fun. Okay, not correct also never mind. Not accurate, never mind. Jason says less than 10%. Okay. Hui Zhen says 15%. So that means better than annualized, okay? Or somewhere around annualized, less than 10%. What about the rest? Do you have a guess? Flat? Okay, flat means about 0%. Okay, so okay, King Xiong says 5 to 10%. Okay, so since like most of us here are still on the bullish side, okay, but perhaps maybe not that bullish such that we are expecting, like 20%. Okay, I see another response. Robin say less than 10%. Okay, now if you go to the YouTube or if you go to read articles online, there will always be people or even famous investors or famous traders talking about the market's going to be crashing. This year you see it. Last year you probably have read one of those content as well. 2 years ago, 3 years ago, in fact, every year you see all this. There are always people talking about the market's crashing. Okay, every year there will be someone predicting that. And of course, if year after year, they are always predicting that the markets are going to crash, at some point in time, of course, they're bound to get it correctly. But then there is nothing impressive if they get it correctly for that year, because they have been saying that the same year, same thing every year. But something that's more important to understand is that when you're investing in the US stock markets, if you want to go against the US stock markets, if you want to short the overall US stock markets, the odds are generally working against you most of the time. Why do I say so? Okay, let's take a look at some statistics. Okay, in history, the average length of a bull market, okay, if you see over here, the average length of a bull market is 1,764 days. And in comparison, the average length of a bear market is only 349 days. Okay, that means to say the bear market is shorter than the bull market. Okay, if just by looking at these numbers, it doesn't convince you, let's take a look at the diagram here. Okay, if you look over here, all these dark blue regions, it represent the bull markets. And the light blue regions below the x-axis, it represents the bear markets. So since 1968, we can see that majority of the time, the S&P 500 is in a bull market. So if you want to be correct most of the time as an investor in the US stock market, then what should you do? You should always go with the trend of the markets and not against the trend, which is why if you want to short the overall US stock markets, the odds are generally working against you most of the time. Well, I can't predict when the next crash is going to come for the S&P 500. But if you were to ask me to give you a guess on how I think the US stock markets are going to be performing in 2022, please do not base your investing decisions on this. Is that I'm still holding on to a rather bullish sentiment for 2022, but perhaps tilted slightly more towards the cautiously bullish side. Okay, why do I say so? If you look over here at this S&P 500 chart, this is the S&P 500 index on a weekly view. So what you can see over here is that something that is a little concerning is this gradient of the S&P 500 index. The red color line is the gradient of the S&P 500 index since the COVID crash, from after the COVID crash to right now. And this green color line over here, it is the gradient, the general gradient of the S&P 500 since sometime about 2000 2001, 2002. Okay, so this is about 20 years of data. So what you can see is that this right now, S&P 500 is actually climbing at a very, very fast rate, such that the gradient is actually much steeper than the overall general gradient that we have been having historically. So this is something that could be a little more concerning, but I'm not saying that there's going to be a crash, okay? Because as long as the earnings for the S&P 500 companies can continue to keep up with the stock prices, then it will be all right. Okay, but if the earnings cannot continue to keep up with the prices, then a deeper correction might happen. But my guess is that it would not be that extensive as a crash. A crash is 20% or more. A correction is just 10% or so. So this is why I say that my guess is that it would be a cautiously bullish. My guess is cautiously bullish. And what we saw towards the end of 2021 was that the S&P 500 was actually mainly supported and being pushed up just by a few top performing companies like Apple, Google, Microsoft. If you do not realize, towards the end of 2021 last year, many companies were actually having a retracement. They were experiencing a pullback, except for these few companies like Apple, Google, Microsoft, which were still rallying up rather strongly. And these are the companies which actually have a greater weighting in the S&P 500 index, which is why they are the ones who are actually holding up and pushing up the S&P 500 towards the end of 2021. So if these companies also come down together with the other companies, then you will expect that the S&P 500 would have a bigger retracement. Okay. So having said that, I do think that there might be a deeper correction, but I don't think there will be a crash for the S&P 500. And this is the reason why. If we look at the US Treasury yield curve, this has been, the 10-year and 1-year spread has been a very good indicator to predict recessions. Historically, this 10-year and 1-year spread has been a very good prediction of the past 7 recessions. How do you look at this graph over here? Is that if the graph goes below to the negative portion, that means to this part, if the graph goes below negative portion, that is an indication that a recession may be coming. So it has actually accurately predicted the last 7 recessions. If you look at here, let me draw out those areas. These are the last 7 recessions. Okay, so which is why I say that I don't think a crash is coming, because if you look at what is happening right now, is that right now we're at about 1.28. So that is actually still on the positive side. So I don't think that a crash may be coming yet based on this, but we can always be observing this 10-year and 1-year yield spread. Okay, why a negative spread is bad is because, okay, why is it that negative means a recession is coming? It is because under the normal economic conditions, if you're holding on to a bond that has a longer time period, you should generally be getting a higher yield to compensate you for the higher risk for holding on to the bond for a longer period. That is why a 10-year yield will always be higher than a 1-year yield during normal economic conditions. Okay, but during times where a recession is coming, that is when things start to invert, which is why a negative spread is bad. That is not normal. Okay, so looking at the latest spread, things still looks good, and we are still in a bull market. So that is just my opinion and my guess. I could be wrong, so please do not take it as financial advice. So other than the 10-year and 1-year spread, you can also look at 10-year and 2-year spread. It has also been a very good and one of the famous indicators that have predicted the last 7 recessions. And how to look at this is the same as how I explained for the other one earlier. Okay. Okay, so how we are positioning ourselves in the US stock markets is this. Number 1, buy shares of companies which have strong pricing power. And when I say strong pricing power, what it means is that businesses can very easily pass on the higher costs that they incur from the supplier to the customers by raising the products of the goods and services. So they are the ones which have the pricing power. For example, if you look at Apple, okay, Apple business. Apple is a company whereby they have a strong pricing power. You look at their latest or newest iPhone models, they are always sought after. Even though the price of the iPhone, the latest iPhone model has been increasing over the years, but people still buy. And you don't see Apple giving discounts. They don't give you discounts on the latest model. They continue to increase the price more than $1,000. Yeah, but people are still buying because Apple have the pricing power. So businesses with strong pricing power are the ones which can survive very well during inflation. Okay, and they might even do better because they are the ones who can pass on the cost to the consumers. Right. Number two, invest in companies which are not capital intensive. For example, software companies like Microsoft, Adobe, they don't have to incur much additional costs for every new customer subscription. Therefore, when they have more and more customers subscribing for the services, for the softwares, they can continue to generate higher and higher revenue. While at the same time, their cost of producing that same software to be made available in the markets, it is contained. Okay, they don't have to increase a lot on the cost side, but they can increase the revenue side. That is how they can increase their profits and increase their margins. So these are the companies which are very strong during times of inflation. Okay, and lastly, in terms of S&P 500 and stocks picking, right now I'll be focusing more on stocks picking than buying the S&P 500 index. I will only be buying the S&P 500 index when there is a deeper correction because of the very strong rally that we have seen, which I've explained earlier on. So this is why right now I will be focusing on stocks picking. Okay, our investing style is never to chase after prices. So even though prices have rallied up by a lot, we won't chase after the prices. We only wait until the prices come down to us, then we buy. In the meantime, there are always many other opportunities available because there are many stocks in the stock markets. Okay, we never chase after prices, and in fact, we hate chasing after prices because the risk to reward setup is not working in our favor if we are chasing after the prices. So our main focus right now would be positioned towards buying the good stocks, the good and sound stocks, which are facing a sell-off right now. It could be due to any reason, COVID, inflation, rate hikes, or any other new reason that comes along. But we know that these are not actually related to the fundamentals of the businesses. Okay, eventually these good stocks, they will recover over the long term. They will recover because they have strong fundamentals to support their stock prices. In fact, during this recent tech sell-off, over the past 2 weeks, we have also been accumulating some of the tech stocks at good prices. But to be able to do so, you need to have conviction. If you don't have the conviction in the stocks, that when you see a sell-off, you wouldn't dare to go in and buy the stock. So in the first place, you need to have the knowledge, you need to know how to screen for the good stocks and have the conviction to hold on to those stocks, even during times when prices are coming down. Okay, so this is how we will be positioning ourselves for the US stock markets. Okay, next one is China markets. Right, China economy was the first to make a very strong recovery during the pandemic season. Okay, they were the ones who actually had a very strict lockdown, and then they brought all the number of cases, COVID cases, down very quickly. But because last year they had a series of regulations, as well as we saw the slowdown in the real estate market, so the growth momentum actually slowed down in the second half of 2021 for China. And moving forward, the real GDP growth for China economy is projected to be at about 5% in 2022. And it's forecasted to stabilize at around that level, 5%, over the next few years as well. So what is interesting about China is that, there seems to be a slowing down of the GDP growth in China, because in the past, if if there was a slowing down of GDP growth, the Chinese government would have had more aggressive macro stimulus in response to a slowdown in GDP growth. But lately, what we are seeing in China is that the Chinese government seems to be heading towards more of financial stability and more equitable income distribution, rather than just focusing on the near-term GDP growth. Or in other words, they're trying to make China become a more equitable country, which is in line with the common prosperity thing, right? And you can see over here, according to Morgan Stanley estimates, due to the regulatory reset, you can see that without regulatory reset, the growth is supposed to be higher. But because of the regulatory actions that China had, that is going to bring down some of their growth in the future over the next 3 years. So right now, this doesn't matter for China. It seems to be so because right now what they seem to be focusing on is quality over quantity. And President Xi seems to be able to tolerate shorter-term economic pain for longer-term economic resilience. Okay. And when we talk about the China economy, or if we talk about just China market, stock markets, China stocks, anything about China has always been very controversial, where you can see very distinct stance of pro-China and anti-China, right? Even how China is still keeping to its very strict zero COVID strategy. This is something that has also been very heavily criticized by people from other parts of the world. Just a few weeks ago, we saw that China had another lockdown in one of the cities as it prepares for the Winter Olympics. So it seems that China is still going to be continuing to keep its zero COVID policy. Well, the Western media has been very used to portraying China and its policy in a more negative light. Anything about China is almost always bad, except for a few more outspoken figures like Ray Dalio, who speaks up about his bullish thesis for China's economy and China's investment. But what we need to understand about China is that China is very different from the US. Okay, we cannot be looking at China the same way that we look at US because they are very different. Part of the 5-year plan that was set up in 2021 for China was to focus on the dual circulation economy model. What this means is that domestic consumption will take the primary role while international trade will be the supplement. So this is part of China's plan to achieving national economic self-reliance, or in Chinese, what they call 自力更生. So that if other countries, or if let's say the US decides to impose economic sanctions against China, China's economy will not be that impacted because it is self-reliant. It has the technologies, it has the capabilities, it has a large enough population such that the domestic consumption is sufficient for its economy to grow. So this is what China is going towards, which is why I say China is very different from the US. China doesn't believe that growth has to come from liberalization. In fact, the Chinese citizens, they think that the country's growth and prosperity over the years came from the China government's style of ruling. So using the same growth trajectory that has worked for the US or that has worked for other countries to judge and assess China may not be the most appropriate. Okay, it is in the culture that China adopts a paternalistic leadership approach, which means to say never go against the China government, or else she will come with the cane, like a parent caning her disobedient kid, like what happened to Jack Ma, right? So never go against the China government. And in fact, some of us may not know, okay, this is actually not the first time that the Chinese regulators are cracking down on the private sectors. In the past, China also had crackdowns before. on luxury goods, on pharmaceutical sectors. And even when it comes to entertainment and celebrity culture, the Chinese government also want to have a say. Like you see, they came for the men earrings. So if you want to invest in China, then you must be prepared to embrace more volatilities that are related to the political climate of China. Because investors have to understand that China is not just a pure economy, it is a political economy. But eventually, it is still in the interest of the government for the overall economy to prosper. So it is very important that companies do not get in the way of what the CCP is trying to achieve. Okay, so this is what we have to understand. Okay, China's story and the US story is very different. Okay, so let's now take a look at the charts for the China markets. So for last year, 2021, if you look at the CSI 300 index, which tracks the top 300 A-share stocks that are listed on the Shanghai and Shenzhen stock exchanges, it is actually only down by about 6.2%. Okay, it is only down by about 6.2%. Because actually last year, the China stocks that have the biggest hit from the regulatory crackdown are the tech stocks, which are listed on the Hong Kong stock exchanges. So if you look at Hang Seng Index was hit more. It was down by 14.8% for 2021. Okay, Hang Seng Index is the benchmark for the blue chip stocks that are traded on the Hong Kong Stock Exchange. It was down by about 15% last year. And of course, if you look at individual stocks like, say, JD.com, Alibaba, Tencent, all these would be, they were hit even more. So they were down even more last year. So in the short term, if you look at this chart over here, you can see that things look very bullish. Seems to be very volatile, right? And things look actually very bullish. But if you toggle to the weekly view to look at a longer time period, then you can see that actually overall there is still an uptrend for Hang Seng Index. Okay, the Hang Seng uptrend is still pretty much. Okay, if you look over here, this green line is the line that I've drawn. This is what we call the trend line. Okay, this is a trend line that how we form this trend line is to connect all the swing lows. Okay, that means all this part where the stock prices went up and then it retraced down, went up, then retraced down. So when you connect all this, we actually form a trend line. And this trend line is actually slanting upwards, which means to say that there is still an upward trend for Hang Seng Index. And something else that we can read from this is that this trend line is actually a very good support line for the prices of the Hang Seng Index. Meaning to say, prices, when it comes down and hit this line, it will rebound back. And then it comes down and hit this line and it rebounds back again. Then it hits this line, rebound back again, comes down and rebound back. Meaning to say this line is actually a very good support line. So right now we are actually at this point over here. Can you see? Right now we're actually at this point here. So that means to say there is a very, very high chance that prices would rebound back up from here because this is a good support. But when we are reading technicals, there is no 100% guarantee. Okay, just like there is never 100% certainty in the stock markets. So this is the best that we can analyze from this chart over here to help us make more informed decisions. So there is a good chance that the prices may rebound up from this point here. But take note, there is no 100% guarantee. Okay. Okay, so what's our plan for the China tech stocks? If you have been following us for on our YouTube channel, on our videos, you will know that we actually hold on to a rather solid concentration of China tech stocks. And our portfolio performance has been pulled down by the China tech stocks. We are very transparent when we do our portfolio results and review. All of these are shared on our YouTube videos. If we do well, you will see that we share that we do well. And if we are temporarily being dragged down by certain events, you will also see our results. Okay, so we are very transparent when we do our portfolio review. So there is actually no secret ingredient to this. We will still be holding on to our China tech shares. Bearing in mind that things actually work very differently in China as compared to in the US. So our conviction in all this China tech stocks still holds. During this kind of times, what is very important is the investor's mindset and the psychology. That is very important. Investing is not about making sure that you do well for just that one quarter or 1 week or that 1 month. Sometimes you will need more time for things to play out, okay? Because we cannot predict when it is going to be over. So sometimes we will need more time for things to play out. But the problem for many investors is that they need to have instant gratification. They want to see the results immediately. While sometimes you might be able to get instant gratification, but that could just be luck. And you cannot be guaranteed to be that lucky every time. Okay, so the idea of delayed gratification is very important when it comes to investing. And understand that what comes after every bear market would be a new bull market. Okay, so this is a cycle. When you see that everyone around you are all very sick and tired of China stocks, they are all giving in and selling away the China stocks, that is an indication of when capitulation may be ending soon and giving way to a new bull run. Okay, so this is how we are positioning ourselves in the China markets. Okay, last part is on Singapore markets. For the Singapore markets in 2021, we saw the Singapore economy rebounded to the fastest in more than a decade. And of course, this is also aided significantly from the vaccinations that we have, Singapore being a largely vaccinated nation, and also the opening of travel via the VTLs. So all these aided our growth as well, as we try to actually go back to normal and to live together with COVID, to shift from pandemic to endemic. So in December last year, we also shared in our Telegram channel, during that time, the Singapore markets, the US markets, they were jittery with the news of Omicron. We also saw pullbacks, reasonable pullbacks in the financial markets. So we shared in our Telegram channel that it was an opportune time to do some bargain hunting in the stock markets. Because you see, as an investor, you must always think two-dimensional. What are the two things? One is risk, one is return. Most investors only think of either one. Okay, if you only think about return, you will always be chasing after the prices. If you only think about risk, you wouldn't dare to go in when there is a sell-off. When prices are coming down, you wouldn't dare to take action. And if you don't take action, you will never be able to earn the investment gains. So as an investor, you must think two-dimensional, both risk and returns. So what we need to do is to learn how to take calculated risk that is compensated by good future upside. So never just anyhow jump in, and also don't just stay out and being too scared of getting into the stock markets because of the sell-off. If you haven't already followed us on our Telegram channel, where we share timely market insights, you can join us at this t.me/thejoyfulinvestors. Or within the Telegram app, I think if you just type the Joyful Investors, you'll be able to find us as well. So you can join us, okay? Because we'll also be sharing, when we have such sharing sessions, we'll also blast it out in our Telegram channel as well. Yeah. So moving forward for Singapore economy, what we are expected to see is that the economy will grow by about 3 to 5% in 2022. For those of us who have been following us, you know that for the Singapore markets, we are mainly into the Singapore REITs and the 3 local banks for both the dividend yields and the capital gains. So for today, let's put our focus on the Singapore REITs. Okay, last year, 2021, the STI index outperformed the IHS REIT. Okay, if you look over here, this is the Singapore REIT, and this is the STI. So STI delivered 13.6. Singapore REIT is about 6.2%. So STI outperformed the Singapore REIT. Okay, and why is it so? It is also because of this. This one is the return of the 3 local banks. Okay, if you know the makeup and the weighting of the STI index, you will know that the 3 local banks take up about 45% of the STI index. Their weightage on the STI index is about 45%. So if these 3 local banks do well, like what they have done last year, it is going to pull up the STI index, which is why the STI index actually did better than the REITs index last year. But then it's only just for that 1 year. If you zoom out in time to look at a longer period over the last 10 years, you can see that the Singapore index is the gray color line. You can see that this is the Singapore index, and then the other two are the REIT index. You can see that actually overall, over the long term, actually REITs still do better than the STI index. So overall, how would Singapore REITs be affected if the interest rates increase under inflationary landscape? Okay, in theory, we learned that rising rates would make share prices fall. Okay, rising rates would, in theory, will make the REITs less attractive especially because REITs is actually a yield-oriented asset. Okay, but this is assuming that all other things are equal. Okay, so again, this is the theory part, because in theory, we always learn that every other things are equal. There's only one variable changing, which is interest rates. But in the real markets, there are actually many variables changing at the same time. So the relationship between interest rates and Singapore REITs may not actually be that straightforward and clear-cut. Okay, let me show you. Okay, let's focus on what history tells us again. If you look over at this chart here, you just focus on the gray color line. The gray color line is the 10-year yield. Then the dark blue or slightly green color line, that is the REIT index. Just ignore the light blue line. So during those blue shaded regions, those are the regions whereby the yield increase. So we're going to see how the price of the REIT, Singapore REIT index move in relation to this rising yield. Okay, if you look over here, this has been tabulated in table form. Out of this 7 periods whereby the yields are increasing, the Singapore REIT index actually show, look at this, actually 2 out of the 7 periods, it actually show a positive correlation. Okay, that means to say that out of the 7 periods, there are 2 periods whereby the Singapore REIT still delivered an increase in price. The REIT index still went up, it still climbed. So actually, it is actually not with certainty that when interest rate increase, Singapore REITs will definitely underperform. Okay, then another interesting observation that we have is that out of these 7 periods, there are actually 3 periods whereby the Singapore REITs outperform the SCI during times where the interest rates are rising. So I would say based on this result, there's actually not with certainty that, you know, when interest rates are increasing, the Singapore REITs are definitely going to be doing badly. Okay, and the reason again is because in the real markets, there are many things changing. In practice, things do not work in a manner such that there is only one variable changing. For example, it could be specific a specific sector factor that is affecting that sector of REITs, or it could just be the fundamentals of that specific Singapore REIT itself. So there are actually many factors that are changing at the same time. So we cannot say with certainty that if interest rates increase or if there is inflation, Singapore REITs are going to be doing badly. That is not with certainty. Okay, so what we learn on textbook in theory, we always assume that every other things are kept constant. But in real life, it is not that straightforward. Okay. So for Singapore markets, how we are going to be positioning ourselves is that firstly, for the local banks, because the Fed has announced that it will begin its rate hike cycle this year, so the high interest rates environment will generally bode well for the Singapore local banks. Okay, but we believe that stock prices have been pretty much priced in, so we will be liquidating, or we have already been liquidating, some of our remaining Singapore bank shares to capitalize on the more attractive upside from Singapore REITs. Okay, let me explain to you. So our investment style and our investment philosophy is such that when we see more and more investors chasing after the same stock, we wouldn't go with the crowd. In fact, for us, that is a time when we are going to sell them away. Because when you have many people chasing after it, when you have many people buying it, that is how the buying pressure is going to help you push out the price. And that is when we will sell off some of our shares at a good price to take profits. Because the thing is that we all have very limited capital. So we want to have a more efficient and good use of our capital. So by doing that, we will then shift our funds to buy those stocks which are being beaten down. Like for example, Singapore REITs, okay, at a cheap and bargain price. So this is how we go about doing our investment trades. Okay, and let's see. Okay, so for certain quality real estate assets, they might have some pricing power, and that can also negate the effect of rising interest rates, because things are not always, like I said, things are how things work in practice is such that there are many factors changing. Okay, there's not just interest rates. So there could be some very quality Singapore REITs which offer very good opportunities for us to buy them. Okay, and right now, if they are being beaten down, we would love to buy them at a very cheap and good price, so that we will also have a good long-term capital appreciation in the future, on top of just the dividend yields that we are getting from the Singapore REITs. So at this juncture, we find great value in industrial REITs, in data center REITs, which are more resilient. And its demand has also been lifted by the structural trends that was caused by the post-COVID situation, such as the continuing growth of e-commerce. So we would need to have all these data centers as well, the cloud services, servers, and all that. Okay, while there are still investment risks from Omicron or possibly other new COVID variants in the future, but we believe that the situation right now in Singapore, it is still manageable, okay, because we have a large population which have been vaccinated and also having the booster shot. So actually Singapore is in a very much hopeful situation as compared to some other parts in the world, right? So this will be how we will be positioning ourselves in the Singapore stock market. Okay. So with that, that's the end of our sharing on the market outlook for 2022 and how we are positioning ourselves in the markets for this year ahead. Wow. Yeah, thank you very much for joining us in this sharing session today, and I hope you will have a great year ahead in the stock market.